Unraveling the Abraaj Group, inside the $1 billion private equity scandal. In the sprawling landscape of global finance, private equity firms are often seen as engines of growth, raising money from investors and deploying that capital to nurture companies, create jobs, and boost economies. But what happens when one of these giants, trusted with billions, not only fails, but unravels in one of the largest financial frauds of the decade? This is the story of Abraaj Group, the $1 billion private equity fraud that rocked emerging markets, shook investor confidence, and exposed vulnerabilities in the oversight of global finance. Abraaj Group was founded in 2002 by Arif Naqvi, a Pakistani-born businessman who built the firm into the largest private equity firm in emerging markets by 2018. The firm managed nearly $14 billion in assets, with investments spanning Africa, South Asia, the Middle East, and Latin America. It claimed to promise not just financial returns, but social impact, pioneering a model called impact investing, aiming to generate profits alongside positive societal outcomes such as improved healthcare and infrastructure. For many investors, from sovereign wealth funds and pension funds to development banks and private individuals, Abraaj seemed like a bold innovator in a region starved of capital. But behind the impressive headlines and glossy reports, a darker story was unfolding, one of misused funds, inaccurate accounting, and ultimately a massive liquidity crisis that culminated in the firm collapsing in 2018. At its core, the Abraaj scandal was a case of financial engineering gone rogue, combined with weak governance structures and regulatory oversight stretching across multiple jurisdictions. To understand exactly what happened, we need to unpack how private equity firms like Abraaj operate, where the fraud happened in their financial mechanics, and how it rippled through both their investors and the emerging market economies they touched. Private equity firms raise money by creating funds, usually with fixed lifespans around 10 years. Investors commit capital, which the firm then calls upon to make investments in companies, with the expectation that these investments will grow in value and generate returns when sold or taken public. Crucially, these funds are meant to be independent pools of capital, held separately from the firm's own assets or other funds. This ensures transparency, investor trust, and regulatory compliance. Abraaj deviated significantly from this model. The firm's flagship fund was the Abraaj Growth Markets Health Fund, launched with ambitions to invest in healthcare companies across emerging economies, a sector close to Naqvi's heart, given his vision for impact investing. By 2017, the fund had raised $1 billion from a host of global investors, including the Bill and Melinda Gates Foundation, the International Finance Corporation, IFC, the private sector arm of the World Bank, and the government of Kuwait, among others. But concerns began to emerge around the fund's management in 2017 and early 2018. Independent auditors and investors noticed discrepancies in financial reporting, delayed audits, and most alarmingly, liquidity problems that forced Abraaj to delay returning capital to investors. Digging deeper, auditors found that around $200 million of the health fund's money had been improperly transferred to Abraaj Group's own operating company. Instead of being invested in portfolio companies as promised, this capital had been used for cash flow purposes, paying down debts and operating expenses unrelated to the fund's stated mission. This practice is sometimes called misappropriation or unauthorized use of investor funds. In Abraaj's case, the firm had effectively been borrowing from the fund to keep its own business afloat, a clear conflict of interest and violation of fiduciary duty. Investors were shocked. The firm's inability to clearly account for this money sparked a chain reaction, causing delays in raising new commitments and forcing the firm into restructuring talks. Publicly, Abraaj promised that the fund would be made whole and that these funds would be repaid. Behind closed doors, though, agents from major investors, including the Gates Foundation and the IFC, began pressing for independent audits and governance changes. The U.S. Department of Justice and UK Serious Fraud Office eventually launched investigations into the firm's activities. The financial analysis would later show that Abraaj had been hiding a liquidity shortfall of roughly $1 billion, partly the misappropriated health fund money, but also exacerbated by overall poor risk management and aggressive fundraising to mask losses in other funds. Essentially, Abraaj was using new investor money to cover shortfalls and debts, a form of financial sleight of hand called a Ponzi-like scheme by some analysts. The unraveling culminated in March 2018 when Abraaj agreed to appoint a third-party firm, Alvarez & Marsal, to conduct an independent review of the health fund's finances. That report confirmed the misused funds, and as a result, the firm's key investors pulled back, forcing Abraaj to seek court protection in the Cayman Islands in mid-2018 and begin an orderly wind-down process. By mid-2018, the firm announced it would sell its assets and return as much capital as possible to investors. Arif Naqvi resigned as CEO, and shortly afterward, investigations intensified in multiple countries. As of 2023, Naqvi has faced charges in the United States for conspiracy to commit wire fraud and other financial crimes. In September 2023, he was found guilty on multiple counts in a New York federal court. But what does this mean for investors, the emerging markets that Abraaj claimed to serve, and the broader global financial system? The impact was immediate and profound. Over 300 investors globally lost confidence, including sovereign wealth funds representing billions of dollars in public money. The Gates Foundation had committed $50 million to the health fund, and while they stated they had safeguards in place and risk was limited, the scandal nonetheless tarnished their reputation. The IFC, which had invested $110 million, tightened its due diligence processes to prevent a recurrence of such failures. On the ground, companies in Africa and South Asia, especially in health-related businesses like hospitals, pharmaceutical suppliers, and diagnostics firms, faced uncertainty as promised capital injections were delayed or withdrawn. Some of these businesses depended directly on Abraaj's financing for expansion or critical infrastructure projects, meaning the fallout slowed development projects and job creation. The Abraaj collapse also sent shockwaves through the private equity industry focused on emerging markets. It exposed the difficulties in managing complex cross-border investment structures where regulators have limited jurisdiction and due diligence relies heavily on trust and periodic audits. It also highlighted the growing pains of the impact investing sector, which blends profit motives with social outcomes but can mask conflicts between managers, incentives, and investors' expectations. Regulatory scrutiny has intensified since. For example, the UK's Financial Conduct Authority, FCA, issued warnings about oversight gaps in firms managing complex funds. The International Organization of Securities Commissions, OSCO, revisited guidance on private equity transparency and investor protection. These reforms aim to prevent a repeat of Abraaj's entanglement of fund money with corporate cash flows. But fundamentally, the Abraaj saga is a textbook case of breakdowns in governance and controls. At its core, the firm's willingness to blur lines between funds and its own finances betrayed fiduciary duties central to private equity's model. Many observers point to the firm's rapid growth, from $2 billion under management in 2012 to nearly $14 billion in 2017, as a factor that outpaced the development of strong internal financial controls. One of the most intriguing aspects of the Abraaj story is how it mirrors classic patterns of financial fraud. The firm's aggressive fundraising, opaque reporting, and use of new capital to cover holes echo symptoms visible in notorious cases like Enron or the Madoff Ponzi scheme. Yet the geography and sector, emerging markets and impact investing, gave Abraaj a veneer of legitimacy and innovation that helped postpone scrutiny. Investors, seduced by the prospect of above-average returns, combined with positive social impact, may have lowered their guard. Another layer of complexity involves international legal challenges. Since Abraaj was based in Dubai, with funds domiciled in offshore jurisdictions like the Cayman Islands and investors spanning the globe, coordinating investigations and asset recovery became an intricate affair. Different legal frameworks, conflicting priorities, and questions about international enforcement capacity slowed resolution and complicated reimbursements. Numerically, the losses attributed directly to the fund misappropriation estimate at about $200 million, as per Alvarez and Marsal's review. But the broader damage to investor trust and the delayed investments countless emerging market businesses relied upon likely add up to many times that figure. Precise tallies remain challenging due to the ongoing liquidation of assets and legal proceedings. By late 2023, the practical takeaway for global finance professionals is clear. Even sophisticated investors need robust internal controls, rigorous independent audits, and vigilant regulatory frameworks, especially when investing in complex funds operating across multiple jurisdictions. The Abraaj collapse serves as a stark reminder that without these safeguards, even firms promising social good and economic development can devolve into instruments of systemic risk. In sum, the Abraaj Group fraud story is not just a tale of corporate betrayal, but a magnifying lens on the fragility of emerging market finance, the challenges of cross-border fund management, and the inherent tensions in impact investing models. It forces a reckoning about trust, transparency, and oversight in a fast-growing sector increasingly central to global capital flows. The mechanics of the fraud were almost laughably simple. Move funds intended for one purpose into another entity's coffers, delay audits, and keep raising new money to cover shortfalls. Yet this simplicity highlights the dangers when rapid growth outpaces controls and when regulatory gaps exist across borders. For investors and policymakers, the Abraaj case underscores the critical need for continuous vigilance and clear governance structures. The model of private equity can be powerful, but only if the lines between investor funds and firm operations are strictly maintained. Otherwise, the entire structure risks collapsing under its own complexity and ambition. The ultimate lesson from Abraaj is one of caution, but also of resilience. Markets can learn, regulations can adapt, and emerging economies can rebuild trust. But only with full transparency and accountability can the promise of private equity and impact investing be realized for the billions who rely on these funds to build better futures. As of now, Abraaj's story remains unfolding. Legal cases proceed, assets are liquidated, and reforms continue. But the imprint of this $1 billion fraud on global finance and emerging markets will endure as a powerful example of what happens when ambition, trust, and oversight collide. This is the Abraaj Group, the rise, the fall, and the hard lessons of one of the largest private equity frauds in recent history. If you found this story interesting, hit that like button and subscribe so we can keep making these videos. Tomorrow, we are diving into a story that is just as shocking. Brex Minerals, the $6 billion gold mining hoax. You will not want to miss it. I will see you there.